Hey there, it's Casey at TaxSaleAcademy.com and welcome to our weekly tax sale question segment. This week's question comes to us from Rachel. It says, hey Casey, I know you sell some properties with clear titles and others without. Is there a certain price point where you know when you should clear the title to a tax defaulted piece of real estate? Rachel, thank you so much for your question. So a little backstory for those folks that are not familiar with what she is referring to when it concerns the titles around tax defaulted real estate. So in a conventional transaction, like you would buy through a realtor, for example, you're going to receive something at closing called title insurance, and it's probably in that paperwork that you didn't even realize it was there. This is insurance from a third party, typically issued through a title company or a real estate attorney, that basically says the title to that property is clear and you'll have no issues as the owner moving forward in the future. So in other words, the person selling that property is the actual owner. They have the authority to sell that property, and there are no liens or mortgages that you are going to get stuck with as the buyer of that property. Now, they issue this title insurance after they reviewed the entire chain of title for that property, which means they'll have reviewed the history of owners, liens, releases, anything that concerns the title. So with tax defaulted real estate, it's a little bit different. There's a break in this chain of title since the owner lost the property due to the tax foreclosure laws. Now, those laws can be complicated in some areas, and title companies don't like the whole tax foreclosure process, so they won't issue title insurance on it in many situations, which means you as an investor need to take additional steps in order to clear that title, or you could sell it with an as-is title without title insurance. Now, if you want to clear the title, there's a few different ways, but the most common are going to be a suit to quiet title, which is a judicial process, an actual lawsuit where a judge signs off and says, yep, the title is now clear. Or you can go through a third party and do something called a tax foreclosure certification, which essentially verifies that everything is done right. And then through one of their partner companies, they'll issue title insurance. Now, each one of those options takes some time, and it also takes some money, $1,500, $2,000, somewhere in that ballpark, depending on the specifics. But it does allow you to sell it for full market value with title insurance. Now, if you want to sell it without title insurance, with an as-is title, with no suit to quiet title, with no tax foreclosure certification, you can absolutely do that, but it does not have the full market value since it does not come with title insurance. That means you have to sell it at a discount, likely to an investor who is willing to accept the risk of buying a property without title insurance. Now, the problem is that when somebody is spending, say, $500,000 on a piece of real estate, they're going to want to make sure that property has title insurance on it. That way, their $500,000 investment is backed by title insurance. And in that situation, it absolutely makes sense to invest $1,500, $2,000, whatever it costs you, to get the title cleared so that you can sell for full market value. Now, on the flip side of that, if the property is only worth $1,500, say it's a vacant lot out in the country somewhere, it doesn't make much sense to invest $2,000 into clearing the title to that property because you'd obviously lose quite a bit of money, so we sell it as is. So back to Rachel's question, is there a certain number where a property should have a cleared title prior to attempting to resell that property? And if so, what is that number? The answer is, it depends. Mostly on the buyer's comfort level with the process. There's going to be some investors who are more than happy to do it. There's going to be other investors who will not do it no matter what the margin, what the discount that they have when they buy that property. So generally, investors are going to be more comfortable with buying a piece of real estate without title insurance through a quit claim deed compared to an end user who is not familiar with the business because they want that title insurance. They want things like they're used to and like they read online. Now, with that said, I usually find that selling as-is titles with quit claim deeds is best for the low-valued real estate. Around $5,000, your buyer pool of people willing to accept a quit claim deed starts to drop, and it begins to continually drop until about $10,000. And once you hit the $10,000 mark, most people will want title insurance. And of course, at that price point, you should have plenty of margin to work title clearing into your budget. Then you can sell the property at full retail value. So understand there are exceptions to that rule. Obviously, it just depends entirely on the buyer and what they're willing to accept. So Rachel, I hope this helps you out. If you have any other questions or anybody watching this video right now has a question, feel free to drop it in the comments section of this video or any of the videos that we have here on YouTube. And I'll definitely respond to you, and I might just record a video response like this one. For more information on tax sale investing, make sure you check out all the links in today's show notes, including the one to our primary site at taxsaleacademy.com. Hey, take care, folks. Bye-bye.